Assalamu alaikum to all of you and a very good evening from my side. My name is Hamas Sarwar and I'm the official trainer of this paper, Financial Reporting FR, and I have been teaching this paper for the last 15 years and taking this session consecutively for the last 4 to 6 years. And I really like to thank ACCA for providing me this opportunity to interact with the students globally. So today is the first day of this webinar, and this webinar is only focused on the examination for June attempt. So do remember this point, whatever standards that we are covering in this webinar, it's not possible to cover the whole syllabus in this 5 days webinar of 15 hours, but I'll be taking the most important and covering the most important areas in this webinar with respect to June 21 attempt. So those who are planning for the September or December, it's not relevant for them. It's only relevant for them who are going to take June attempt. So let's start the session. So please write yes in the chat box so that we can start the session. I want you guys to write yes in the chat box. So that we can start the session. Students who are having some issues in the voice clarity, I would recommend them to rejoin the session. There might be some issue at your end. We can't see you, sir. It's not that important to see me in the session actually. That's the reason I have placed my picture, in fact, on the first slide, so that you can see my picture and my face. So the most important area is FR rather than my face. So okay, I have created a WhatsApp group for you guys for your support that will be available for you guys till the examination date. If you guys are having any sort of issue, you can just send me the message. Even the students within the group can share their views and can solve their issues. The management, ACC management, is going to share with you guys my WhatsApp number and the link. You only need to click on the link and join the WhatsApp group. Secondly, for those students who got flunked in the previous attempt or who are appearing for the second or third time in this paper, are highly recommended to contact with me personally on my WhatsApp number. I will share a special plan for them, and if you follow the plan, it will be definitely make you pass in the session. So this session is for all the students, but I have a separate special plan for those who got flunked previously in any other paper. Like you are going to attempt F7 in this attempt, but previously you got failed in F5 or F7. That means that you need to learn exam techniques and you need to learn the way through which you can pass the paper. But if you are a student who has a history of clearing all the exams in first attempt, then this webinar is more than enough for you. On a daily basis, I will share with you guys an assignment that you need to cover before the next day. And there are 3 mock exams for all the students. If you follow all these instructions provided by me, you will definitely, inshallah, pass this paper with very good marks and in first attempt. So the management had shared the WhatsApp number and the WhatsApp link. No matter if you are having some problem, you can join the session after this 3-hour session. Okay, the recording for today will be uploaded by tomorrow, but before the start of the next session, like day 2, you will be having the recording of day 1, because it will take some time for the ACCA to do some editing, and after that they will upload the recorded lecture on the Vimeo. I will share a link on the WhatsApp group of the day 1 video lecture. You can see that lecture as much as you can. The link is not opening. That's not a problem. If the link is not working, just send me a message on my WhatsApp number. I will add you on the group. Okay. So let's start the session. Okay. Before starting the session, I want you guys to tell me what are the areas that you find difficult in this paper, FR. What are the issues that you are facing in this paper, and what are the IFRSs that you find difficult, or the topics? And do we have any student who got flunked in this paper in more than 2 attempts? Do we have any student who got flunked previously in more than 2 attempts? So it's my recommendation for those who got flunked previously, even a single attempt, that you guys you have to contact with me personally. I will share a plan with you guys, and you need to share your study plan with me, and I will guide you accordingly on daily basis till the examination date. So it's very important for those who got flunked previously, be in contact with me. I will not be able to unmute any candidate here. If you are having some issue, you can send me the any message on my WhatsApp. Single entity questions. I have a problem. IFA 15, 16. So where is the chat box? Chat box is here with that where you're writing. This is the chat box, which is your WhatsApp number. How can I record it? Access the recording. ACCA will share with me the recording. I will share the link on the WhatsApp group that I'm sharing with you guys. Okay. So let's start the session. Today we are going to start with this format of the exam. First, we need to discuss the format of the exam. It has 3 sections: section A, B, and C. Section A will be having 30 marks. Section B will be having 30 marks. Both will be based on the section A will be both based on the MCQs, and section C will be a constructive response area in which you need to attempt 2 questions, each having 20 marks, and total weightage of this section is actually 40 marks. So remember this point: if someone got flunked previously, believe me that your failure is actually related to these 2 sections, because this section is the major part of the paper. The weightage is 60%. So if the weightage of this these two sections is 60%. That means that you can easily pass this paper if you can score even 80% of this 60% marks. So if you will be able to get the 80% marks of the section A and B, then you only need to get 2 marks from the section. Pass this paper. The students who got flunked in this paper are basically not focusing on section A and B, which is very important and very tricky. In fact, section C is very straightforward, in which you'll be having a question of consolidation, or there might be a question of ratios or final account. So these are the 3 favorite areas, and sometimes it might add some of the portion of the cash flow. So these are the 3 important sections, and you must need to do a lot of practice of section A and section B, in fact. Actually, there are some students who are sending me the message. Right now, I will not be able to reply any student because I'm taking the session. After the session, I will reply to each and every candidate, whatever your issues will be. Yeah, there's a feedback from the student. I read the exam report. There is written that only MCQs are not sufficient because the markers will see a representation. Definitely, section C is the essence of the paper. But what I wanted to say is actually the students who got flunked was not because of the section C. I'm not saying this to you guys that you need to just leave section C and attempt section A and B. Section A and B is actually important to pass the paper. So, but it's not possible for you to pass the paper if you leave section C and just attempt section N B and expecting 100% marks, or in fact, if you got 60% marks in section A and B, examiner will give you the failure because of the fact that section A, B, and C are equally important. Recent examiner's report actually is not available. The last examination report is related to September, December 2020, because they give the hybrid papers, publish hybrid papers, and publish the hybrid examiner's report. So for the March session, we will not be having any examiner's report or the past paper. You will all get the report and the paper after June attempt, because they just uh, publish the hybrid actually papers. Isn't there a sufficient number of marks in each section to get an overall pass? No, it's not that type of examination in ACCA. But yes, definitely you need to attempt all the sections. That's important. And if you even got 60% marks on each section, you will definitely got 60% marks on overall basis. You have to prepare the ratio analysis for OTQs too. Yes. For OTQs, examiner might ask you the reason for the movement of a particular ratio. Retakers, I will share the plan for the retakers by tonight. Right now, I'm taking the session. Is there any number of workings in section A and B? No. We use a fifth page during our remote exams. Can we use rough page? You need to see the website of ACCA, where the rules and regulation for the remote examination is available. So it's better for you guys to be very honest with you. As far as my knowledge is concerned, rough working page is not allowed in the examination. You need to use the uh, scratch pad for these. So let's start the session. That's the basic passing percentage. You need to understand this point that the average passing percentage of this paper is 49%. In the March session, the percentage, overall global percentage is 47%. So it is actually one of the challenging paper in the skill module. Moving towards the next slide. Now, this is the session planner. On the day one today, we are going to cover the consolidated balance sheet, and in day two, we will be covering the consolidated P&L with the interpretation of consolidated financial statements. In day 3 and 4, we'll be covering the core IFRSs with final account and its interpretation. And in day 5, we'll be covering some of the remaining areas of the ratios, along with the key IFRSs that is important and relevant for this session. So let's start the topic, that is consolidation. So if you have any question related to the topic, you can just write in the chat box. I will try to answer all the questions from you guys. What is the time of the daily classes will be scheduled from 8:30 to 11:30 according to Pakistan Standard Time. So let's start the session. Key definitions: consolidated financial statements. Examiner might ask you these definitions in the examination. What is the meaning of the consolidated financial statements? Meaning the preparation of the financial statement of a group, assuming as a single economic entity. The basic concept of the consolidation lies under this word, that is single economic entity. Means if you're having 3 companies in a group and each will be controlled by a common company. So whenever we are going to make the consolidated financial statement, we need to add the consolidated financial statement of A, B, and C. The consolidated financial statement is actually the clubbing of all the financial statements available in a group, assuming these 3 are single economic entity. So that is one of the reasons that we cancel out all the transactions that occurs within the group. So it's not allowed in the consolidation to recognize the profit earned by one company from the other company within the group, or to recognize the intercompany balances. So this is one of the most important points. The financial statement of a group, assuming a single economic entity. Group means the parent and its subsidiaries. Remember this point: in a group, only one parent can be placed in a group, and you'll be having lots of subsidiaries. These slides and notes are available in the handout section of this webinar. You can take my handouts or download me these handouts from the handout section. Parent means the company which controls one or more subsidiaries, and the subsidiary means an entity that is controlled by another entity. So in order to make a relationship between the parent and the subsidiary, there must be a control between 2 parties. The company who is controlling the other company is called the parent company, and that is controlled by the parent is called the subsidiary company. Remember this point: only the parent company is allowed to make its own financial statements and consolidated financial statements. That is the responsibility of the parent company to make the financial statements of the group rather than the subsidiary company. So all subsidiary companies only prepare their own financial statements. They're not allowed to make the consolidated financial statement. Control means the power to direct the relevant activities. So this is the basic definition of the control according to IFRS 10. A group does not mean associate. Group means a parent and its subsidiaries only. Second slide. Now, according to IFRS 10, it says the control and investor control the investee if and only if the investor has the following elements. So there are three definitions actually, that there are three criteria that should have to be met in order to gain the control of another entity. The first thing is the power over the investee, that you must have the power over the other entity to direct the relevant activities, means the operating and the financial policies of that company. Second, with exposure or right to variable returns from its involvement in the investee, that from the investee's profit you will be having a variable returns. So we all should know this, that preference shareholders will get the fixed return. So that's the reason they will not be able to control the subsidiary company based on the preference shares. So even if you have got 100% preference shares, it will not be used for getting the control. So it's only actually the ordinary shares which are useful for getting the control of another entity. The ability to use your power over the industry. So first you need to have the power. Secondly, you must have the exposure right to the variable returns, mean you should have the ordinary shares of that entity, and you must have the ability to use the power. So this is the basic definition of control. Now, there are some exemptions available when the parent company is not required to prepare the financial statements consolidated. IFRS 10 consolidated financial states that parents need not present consolidated financial statements, and if only if. So these points and theoretical points are important for section A and B. Examiner might ask you a question that when the parent company is exempted from preparing the financial statements consolidated, when the parent itself a wholly owned subsidiary, when the parent is not registered in the stock market, or nor in the is in the process of registering itself, the ultimate parent produces consolidated financial statements. So if the ultimate parent is producing the financial statement, then there is no other parent who is required to prepare the financial statement. Suppose in a group of 4 companies, if A has acquired shares in B, B has acquired shares in C, C has acquired the shares in D. So from the D's perspective, C will be considered as a parent company for D. And for C, B will be the parent company. And for B, A will be the parent company. But consolidation says if the ultimate parent is preparing the financial statement, then no other parent is allowed to make the consolidated financial statement. So when we see this group chain, this is vertical structure. This is called vertical structure. In a vertical structure, the ultimate parent will be considered as a parent company only. All other will be considered as subsidiaries. What is the difference between ordinary shares and preference shares? Ordinary shareholders have got the voting rights to appoint the board of directors, and the preference shareholder has no voting rights. The first difference. The second difference is the ordinary shareholders will receive the variable dividends or no dividends. Preference shareholder will always get the fixed dividend, and the share of the dividend is fixed for all the years. Sometimes ordinary shareholder will get the lower dividend, or it might be possible that sometime get the highest dividend. And the last point is that in case of the liquidation, preference shareholders will get the priority over the ordinary shareholders. Investee is an entity that, yes. How it will be the parent of other B, C, D? Okay, this is a very important question. A has only acquired B, then how it will be the parent company of, okay. Suppose A has acquired shares in B company. B has acquired shares in C, C has acquired shares in D company. So the question is how A is the parent company of C and D. So for making the group, the most important thing is the control. It's not important that you have got the shares, but it's important that you must have a control of that entity. Now, A has acquired, assuming 80% shares in B, B has acquired 80% in C, C has acquired 80% in D. Now, who will be dictating the policies or communicating the policies of D? In fact, it was C, because C has got the controlling interest in D. So C is actually ruling the company D. And who is making the decisions of D? It is actually B. B is actually taking the control of C company. So whatever B says will be applied in C and as well as in D. And what the B was doing actually, who is dictating and communicating the policies of B? It was actually A. So this is how we control company D, because we are dictating the policies to B. B is actually bound by A, and B will be following the guidelines of A company, and it will be using the same policy of the C, and C will be controlling company D. So the most important definition of the control is the power to direct the relevant activities. So who is exercising the power to direct the relevant activities? So actually, if we say about the D, D was actually controlled by A through B and C. Are you getting the point? Got it. Some example with different percentage ownership. Yeah, we can take from different percentage. But the thing is, there must be a controlling interest. Suppose A has got 80% shares in B, B has got 70% shares in, and C has got 60% shares. So they all have got the different shares, but they have got the controlling interest. So the relevant activities of D will be directed by C, the relevant activities of C will be directed by B, and the relevant activities of B will be directed by A. So it was actually A who is running the whole show of A, B, company B, C, and D. Do we need to find the effective controlling interest? Yeah, this point is actually applicable when we are studying SBR, effective controlling interest, or the vertical structure or the D-shaped structure is actually not examinable in this paper. No, the multiple subsidies will not be going to be examinable in this paper. So I was just giving you the example to understand the concept of the control. Now we have got two questions. Which of the following definition is not included within the definition of control as per IFRS 10? So these type of questions are examinable in section A and B. So you need to be expert. If you wanted to be an expert of these type of questions, you need to understand the fundamental concepts of the IFRS. So let's attempt this question. This one, I want you guys to give the answers. as early as possible for you. So now, what is the best way to give the answer? The best way to give the answer of every question is that if assuming C is the right answer, that you must know that why A, B, and D is wrong. So the question says with the following definition is not. That's the very important thing. It's not including the definition. So A is actually the part of the definition, B is the part of the definition, and D is the part of the definition. C is not a part of the definition. That's why C is the right answer. So it's not mentioned in the definition of the control that you must have got the majority of shares in the investee. Remember this point. If you have got the control, you can have got the. If you have got the control, you will be the parent company of the investee, even if you have got less than 50% shares. So you can even control the company or subsidiary if you have got only 10% shares or 20% shares or 30% shares. So you can control the subsidiary with minority shares. So that's why C is the not the part of the definition, and it's the right answer. For second one, which two? The question says which two. That's very important to see the requirement very carefully. Of the following situation are unlikely to represent control of an investee. Which two is unlikely to have a control? The right answer will be B and E. Owning 55% and being able to elect 4 out of 7 directors. Do we have got the control in this situation? The answer is yes, we do have a control because we are going to select 4. That is the majority of directors on the board of directors. Second thing is owning 51%, but the constitution required that the decision needs to be unanimous consent. Unanimous consent, that means that the decision will be taken by the group as a whole rather than one entity. So that's, you don't have the control in this situation. Having currently exercisable options, which would take the shareholding in the investee to 55%. Just owning equity shares versus preference shares. Always give more controlling interest. Yes, we only need to see the equity shares in order to get the controlling interest rather than the preference shares. We never use the word preference shares for getting the control. So here we have got the control, owning 40% of the shares but having the majority of the voting rights within the investee. You have got the 40, you have got the low shares, but you have got the majority of voting rights. So that means that you have got the control. Owning 35% of the ordinary shares and 80% of the preference shares. So if nothing was mentioned, that you need to apply the rule of 50%. That you must have at least 50% plus shares in order to get the control. But this point is irrelevant, that whatever preference shares that you have will not be used for getting the control. So here we have got no control. So exercisable means. So this is one of the part of IFRS 10, that when you are going to calculate the control, you also need to consider the exercisable options. Exercisable options means that you have got the right to purchase certain number of shares at a particular excise price. Like suppose we have got currently the total shares of the company is 100 and you got 40 shares out of 100. So your percentage will be 40%. But you have got the right to acquire 50 more shares through the option. So the total shares of the company will be 150. And when you got these 50 more shares, your weightage will be 90. So now when you calculate your percentage with 90 shares out of 150, the percentage will be 60%. So now you can control based on the 60%. So exercisable options will be used for calculating the percentage. If we have 20% of the ordinary shares, but we have got 5 out of 7 directors, it would mean that we control the company. Yes, we can control the company if you have got the power to appoint or remove the majority of the directors. Even you have got the control if you have got only 10% shares. That means that when the word exercisable is mentioned means having control. Yes, when the term exercisable is mentioned and after exercising that option, you'll be having a majority of shares. You can see in section part C that it says that you will be having 55% shares after uh, exercising your right. So that means that you have got the majority of shares. But the group ownership rules apply to loss making and held for sale investing. Yes, obviously it will apply. What if the investor has invested in the convertible loans of the subsidiary? Yes, convertible bond can be used for this exercisable option. It just happen in real world with 10% and you can control. Yeah, it happens. Uh, but not at 10%, but like 10%, 15%, 20% shares. Less than 50% with exercisable. Yes, if you have got the exercisable options, but after exercising, you will still not be able to get the majority of shares, then that means that you will have no control. Now, the next thing is the associate. Associate means an entity in which the investor. Now, we're not using the word parent company. Now, its investor has the significant influence. Significant influence means that you have only got the representation in the board of directors. You have got the power to participate. The significant influence means that you have got like one director out of 7. That means that you have got the power, in fact, to participate in the policy making process. When you have 2 directors, that also means that you have got the power to participate in the policy making process. When you have 3 directors out of 7, still it means that you have got the power, but not you are in a position to control the company. But when you have got 4 directors out of 7, that becomes a subsidiary company. So our first 3 are associate companies in which we are in minority, but still we have got the representation in the board of directors. So you are the part of the policy making process, but you cannot exercise your power to rule the company. Okay. NCI is the concept that arises in the subsidiary. It is actually the remaining shares that has not been acquired by the parent company is called non-controlling interest. The equity in a subsidiary not attributable to the parent. So suppose the parent company has acquired 80% shares in subsidiary. So whatever leftover shares will be the part of non-controlling interest NCI. Sir, having one director out of 7 does not indicate Does it not indicate significant influence? Yes, it does indicate significant influence because you have got the authority to participate in the policy making process. If we have got the one director. Yes. Now, here is an important slide for you guys. Examiner might ask you a question in section A and B in which you'll be giving a situation in which the company has got different percentage of the shares. So how you can identify the subsidiary company? So always remember this, that shares is the secondary thing. The first thing that you must need to identify whether we have got the control or not. And control can be identified through the voting rights and through the access to the board of directors. So subsidiary can be identified from the control. And how we assume a control situation when you have got 50% plus more than 50% ordinary shares. Now, what will be the treatment of this situation? You need to apply IFRS 3 for all the subsidiaries. And what will be the accounting treatment? The accounting treatment means it should be the consolidation. And consolidation means you need to add the similar items. Similar items will be added. And we need to cancel out the intercompany balances. All similar items should be added and all intercompany balances should be cancelled. That's the basic concept of the consolidation. Now, how you can identify the associate company? Through the significant influence. Significant influence means that you have got the representation in the board of directors, but not in majority. And it is assumed when you have got 20% or more ordinary shares. And associate will be accounted for under IS 28 with the method. The accounting method that we use for the associate is the equity method. Now, what is equity method? Equity method means that you only need to record investment in associate. You don't need to consolidate the assets or liabilities or equities of the associate company. Only a single line accounting will be applied. Investment in associate plus share of profit or loss, less impairment loss. So this is the basic definition of the equity method, that you need to apply the share of profit. You need to take the share of the profit and add it in your investment. Okay, the question is, they have acquired more than 51% shares but have only 2 directors in board of directors. So it is associate or subsidiary. So there is a question from the student side. All of you are required to answer this question, that if the company has acquired 51% ordinary shares, 51% ordinary shares, and you will be only having 2 out of 7 directors. So would it be a subsidiary or associate? So remember this point, it will be a associate company. Because I have already told you guys that percentage is a secondary thing. Important thing that whether it is whether we have got the majority of the board of directors or not. Very good. So I hope these discussions are clearing the concepts of you guys. If a parent company acquired 100% of subsidiary company, what has left for the subsidiary? Doesn't it indicate a complete purchase? Why we still consolidate it? Actually, if the parent company has got the complete 100% shares, that shows that it is called the wholly owned subsidiary. That this company has been wholly owned by the parent company. But as normally parent and subsidiaries are working with the different legal status, different businesses, they can have different businesses, they work with different names. So we are not going to absorb that company in our overall business. That is called absorption. That's a different accounting concept. Consolidation means that we both are different and legal entities, but I am just controlling your decision making. And if you have got 100% shares, that means that there is no interest or percentage of the profit of non-controlling interest. So the whole of the profit will be earned by the parent company. Can you repeat the equity method? Equity method means that you need to. Okay, let's give you an example for the equity method. Suppose we have acquired 30% shares for 5 lakh rupees, and we have got the significant influence. We have got some representation in the board of directors, and it means that this will be considered as an associate company. So we are going to apply the equity method. So we have initially made an investment of 5 lakh. So whatever profit the associate company will earn in the future, assuming they have earned a profit of 2 lakh after our acquisition, so our share of the profit will be 30%. So what will be the amount? 5 lakh plus 60,000. So my investment is now worth 5,60,000. That's the basic accounting of associate company. So this is just a single line accounting treatment of associate company. You don't need to add the assets or liabilities or equities. Now, what about the simple investment? Simple investment means that you have got whatever percentage of shares that we have got, but you don't have any control or you don't have any significant influence, no representation in the board of directors. And this was the situation that was assumed in case of less than 20% shares. So that type of investment, that is called trade investment, and it will be dealt with under IFRS 9, and the accounting for these is fair value. So whenever we are going to cover IFRS 9 in day 5, we will discuss about this treatment, fair value method. I'm just giving you actually the basic concept of the associate company. There are the slides in which we will be dealing the complete concept of the associate company. So I'm just telling you how you can recognize between consolidation, equity method, and fair value approach. I'm not going into more detail because right now I'm just giving you the basic concept of associate. Examiner might give you the question in which it may tell you that parent company has acquired initially 80% shares and it has sold half of its shares. So what will be the accounting treatment after the disposal? Parent company has sold half of its shares in B company, then what will be the accounting treatment for this? Yes, very good, very good. At this stage, if the parent company has sold half of its shares, then after the disposal, then you need to say whether there is a control still present. If the control is still present, then it will be again considered as subsidiary. But if the control has lost, but now we have got significant influence of that company, so it will be considered as an associate. But there might be a situation in which you will be having no representation in the board of directors. That there will be no person of yours, you have got 40% shares, but you don't have any representation in the board of directors. Then this will be considered as an investment, trade investment, which will be accounted for under IFRS 9. So accounting will be dependent. This column is dependent on the level of influence that you have. Now here is a question for you guys. I'm giving you 1 minute to attempt it. Did you all have joined the WhatsApp group? If not, or if you are having some issue in joining this group, please just send me the message. I will add you in the group. Don't need to worry about it. Is it done? So the answer for this question is, now the question is, so the following is a subsidiary. So you need to identify which one is your subsidiary. 60% shares, but your activities are different. So it does not matter in the consolidation process. The parent and the subsidiary company can have different businesses. So here we have got the control. There is an offer to acquire. So if you have got the offer to acquire 70% share, that means that you have not yet acquired the shares because the negotiation is still in the process of negotiation. The acquisition 45% split share equity shares, in which you can appoint 3 out of 10 directors. 3 out of 10 means it is an associate company. So the right answer will be A. Is it clear to all of you guys? Yeah, is it possible that we have 40% but no representation in board of directors? Yes, it's possible. Now, again, a question for you guys. You have got 1 minute to solve it. One does not show any control. It has control. If the statement was rephrased as offer to acquire 70% ESC exercise, ESC means equity share capital. Right. It's not about the offer actually. In the previous question, when you see the previous question, it shows that you have got 60% shares, and if nothing was mentioned, that means you can control based on 60% shares. There's an offer to acquire equity shares, but it is just an offer that we have not yet purchased that shares. That is the reason we are not in a position to control this company. And this is an associate company. Now, what about this one? Example one. Which of the following should be accounted for as subsidiaries? Okay, you need to identify the subsidiary. Gilbert Company, Priest Company owns 40% shares of the Gilbert Company. This is actually a heading. 40% shares of the Greece company and hold option to purchase another 20%, which can exercise immediately. So 40 plus 20 means you have got the control, 60% shares. Gloves company. Each company owns 60% of the Gloves company and has appointed the majority of the board of directors. Control. Rose company. Peace company owns 80% of the Roger. Roger is a loss making, and Peace company is considering selling it in the near future. So what will be the right answer for this? The right answer will be D. In all the three situations, you have got the point number one. Point number one is that currently you have got 40% shares, but you have got the options. Do you guys know the meaning of options? Options are actually some instruments through which you can purchase shares at a price which is lower than the market value. This is called exercisable price. So if the exercisable price of the option is 100 rupees, assuming, and the market value of each share is 150 rupees. The company is allowing you to purchase shares at a price of 100, whereas the market value of each share is 150. So you can purchase the shares from the company. That is, these are called options. The options are actually equity instruments on the basis of which you can purchase the shares. So if someone has got the options, that means that you can purchase the shares and you can increase your percentage. Yes. Options means instruments which gives you the right to purchase the shares at a particular exercise price. Okay, Roach company, Please company owns 80% of the share. So it is a loss-making company. So if, assuming if you have a brother, who is not interested in studies, who is not going to, who's not good in manners, in the behavior, who is different from uh, other members of the family in terms of behavior, in terms of ethics. So can we exclude that person from the family? The answer is no. That will be the part of the family. Similarly, if the subsidiary company is a loss-making company, it does not mean that you must exclude that company from doing the consolidation. You need to consolidate and show it as a part of the family. %, we have got the right. 5 out of 10 directors. 5 out of 10 directors. Now there is a question from the student side that if the company has got 40% shares, that you have got the right to appoint 5 out of 10 directors, then what will be the treatment? So the treatment for this case will be, if you have got 5 directors, then you need to see in this situation. Examiner will never give you this situation because there is an other concept that is called joint venture. That means a partnership between the companies. So this is actually the part of SBR. So if you can appoint 5 directors and the other party can appoint 5 directors, that means that we have got the joint venture. So this is the third concept other than consolidation and associate. It will be considered as a third or fourth concept. That is the concept of joint venture with IFRS 11. So now, if you have got 5, the authority of 5 out of 10 directors, but the other directors are broken down into other parties, but no one has got the right to appoint 5 equal directors. So that means that you have got the control because you are appointing majority of the directors. So you need to see whether there are equal directors but uh, uh, because of the fact that the joint venture is not a part of the course, the examiner is not going to make you confused in the examination and will not ask the question in which there will be equal percentage on both the sides, because this will be considered as joint venture. The parent company does not use that options to purchase another 20%. Yeah, if the question mentions that the parent company is not going to exercise that option, then definitely it will not be considered as a subsidy. So actually, we don't have that much of time to discuss one point in more detail and to make regular discussions. So if you wanted to discuss or argue with me, you can contact me on the WhatsApp, or you can even call me on my number. But for here, I need to cover a lot of things. So avoid two things. The first one is please repeat, because I cannot repeat one question uh, 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 continuously, because of the fact that I need to cover a lot of things. And you guys will be having the video. You can repeat the video and see the video lecture as many times as you can by tomorrow. Secondly, we need to see the exam tips. So whenever you see an exercisable option from the exam point of view, and the total will be more than 50%, then it will be assumed that we have got the control. Okay, so that's the exam point of view. So if someone wanted to argue with me, you'll be having the whole night. We can have a lot of chat today. Now, Petri owns 100% of the share capital of the company. Directors are unsure whether the investment should be account consolidated. In which of the following scenarios would be an investment not be consolidated? In which of the situation you will get the exemption, but you will not, you don't need to bother yourself to do the consolidation. So here, where we can got the exemption? Please read ABCD. So the answer for this question is D. So these are the situations in which you need to do the consolidation. The first thing is the company is going to sell its investment as it is loss making, but as it has not yet sold that subsidiary, so it should be consolidated. If the parent subsidiary have got the different business activities, so you cannot ignore it from the consolidation. Even if they have got different accounting periods or even different accounting rules, then you need to do the consolidation. There is no exemption on the basis of different business, or the subsidiaries are loss making and we are going to make it we are going to make it sale in the near future, or the accounting period or the accounting policies are different, so you will not get the exemption. Only the situation where you lost the control, then you will say this, that we cannot control the subsidiary. Now, group statement of financial position. So these are the things that you need to memorize: how to calculate the group reserves, goodwill based on the fair value and proportionate, non-controlling interest, structure, subsidiary assets, and fair value adjustment. So these are the basic things that you need to cover in the consolidation process. The first is the group structure. Group structure means that you need to identify that how many shares the parent company has acquired in the subsidiary company. So sometimes the examiner will give you the clear instruction that parent company has acquired 80% shares in subsidiary company, so the remaining will be 20% share. But sometimes examiner might ask you to calculate the percentage. So it will tell you that we have acquired 10,000 shares out of 15,000 shares of subsidiary company. So that means that 5,000 shares will be acquired by the NCI. So your percentage will be 10 upon 15. So what will be the percentage in case of 10 upon 15? It will be almost 67%. So sometimes you need to calculate the percentage. So the NCI share will be almost 33%. Then with respect to the group structure, you need to say that sometimes the parent might acquire subsidiary company, or it might acquire some shares in associate company, or it might acquire some shares in other investments. So you need to identify how many shares the parent has acquired for the subsidiary, for associate, and for other investments, because they all have got different accounting treatment. So it will be accounted for under equity method, it will be accounted for the fair value method, and it will be accounted for under consolidation. Similarly, from the group's point of view, you need to understand the concept of date of acquisition, when the parent company has acquired the shares in subsidiary company, and the reporting date. So from where you got the point that how much period you need to do the consolidation. Like if the date of acquisition is 1st January and the reporting date is 30th June, so you need to do the consolidation for the 6 months. So this time period is very important, because whenever you are going to make adjustments, you need to adjust the thing for the 6 months. If from the date of acquisition till the reporting date there are only 6 months. Where can I ask questions from the teacher? Here you can ask questions where you are writing your question. When the lecture is end, it has just started. The time period is from 8:30 to 11:30. If someone wanted to leave, you can leave. It's your choice. Okay. Net assets of the subsidiary. The second step that you need to understand is to calculate the net assets. So for the purpose of consolidation, share capital and share premium of the subsidiary company will remain the same at both the dates, at the date of acquisition or reporting date. So at your stage, there will be no change in the share capital and share premium at the acquisition date or at the reporting date. With respect to the retained earnings at acquisition and at reporting will be different. Therefore, you need to calculate the post-acquisition retained earnings. Post-acquisition retained earnings means the retained earnings or the profit that the subsidiary company has earned after its acquisition. Like if at the date of acquisition it was 10 and at the reporting date it was 25. So what will be the profit that the parent subsidiary company has earned after its acquisition? The amount is 15. Similarly, sometimes examiner might give you the other component of equity. Then you need to do the fair valuation adjustment. It is the requirement of IFRS 3 that all the assets and liabilities of the subsidiary should be measured at fair value at the date of acquisition. So you need to do some fair valuation adjustments, and there will be an impact of that adjustments. The adjustment, like if you revalue the assets, there will be an upward revaluation, then you need to charge the depreciation as well of that portion. And you need to adjust the unrealized profit here only in the reporting period, only when the subsidiary company sold goods to the parent company. So this is the basic standard format. Yes, even the contingent liability will be recognized as a provision and recorded at a fair value. So all the assets and liabilities will be recognized in the fair value, and this is called the net assets at the date of acquisition, and this is called the net assets at report. And the difference between these two will be the post acquisition profit. Remember this point, that whenever we are going to discuss the fair valuation adjustment, so there might be fair valuation in assets and liabilities. So if the assets will increase, the net asset will increase, but if the liability increases, the net asset will decrease. So if there is an increase in the value of the liability, it should be deducted from the fair value of net assets working. Remember this point. What if the reported retained earnings is not given? Retained earnings will always be given to you. What would be the treatment of ANI? Impairment loss. Impairment loss is actually will be recognized directly in the consolidated retained earnings and NCI. Okay. So here is a question for you guys. You need to calculate the retained earnings, net assets at acquisition. I'm showing you the format again. This is the format. Examiner is asking you to calculate the net assets at acquisition. So this is the point that you need to calculate. Please calculate this question. How to calculate share premium? Share premium will be given to you. Yeah, it's not a problem that if you can use the different method. We will talk about the impairment loss. Just wait for a minute. We'll discuss about the impairment loss in the next few slides. Actually, the people from outside the Pakistan will need to write the plus 923322134466. I'm sharing my number here again. You can add me. Okay, let's solve this question. The share capital value is 2 lakh. Share premium value is 1 lakh. And the retained earnings. You need to know the retained earnings at the date of acquisition. So this is the retained earnings at 31st December 20x1. You need to know the retained earnings on 1st January because the 1st January is the date of acquisition mentioned here. So in the whole year, you have calculated the profits of 36,000. Retained earnings at end is 1,80,000. What will be the retained earnings at the acquisition? So at acquisition, it will be 1,44,000. So 4,44,000 will be the answer for this question. Is it clear to all of you guys? It's my humble request to all of you guys that it's not that possible for me to repeat the slides again and again because of the fact that we have got a very limited time for this refresher. It is actually a 120 hours course, and we are going to complete this in just uh, we're going to complete this in just 15 hours. So if you have got any problem in this question, please do ask. But I will not be able to discuss the previous slides right now. 85 for sure. How do we calculate the retained earnings? Okay. Suppose retained earnings at the start is 1 lakh and current year's profit is 10,000. So what will be the retained earnings at end? If the retained earnings at start is 1 lakh and the profit for the year is 10,000, what will be the retained earnings at end? Retained earnings at end will be 1 lakh 10,000. So if someone told you to calculate the retained earnings at start from the retained earnings at end, then what you will do? You just simply deduct 10,000 from the closing balance to get the retained earnings at start. This is what we have done. You need to find out the retained earnings at start. Current year's profit is 36,000 and the retained earnings at end is 1,80,000. So you need to know the retained earnings at the start. So when we deduct the value, we got the value of 144. So the post acquisition profit is actually 36,000. Post acquisition profit is the profit that we have earned after the acquisition. So you need to, if the financial statement is 6 months, then you need to deduct the 6 months profit. Here is another question for you guys. No, you need to take the whole profit. We never apply the percentage in at calculating the retained earnings at acquisition. The percentage will be applied only when we are performing working on the post acquisition profits. Okay. So what I have done, I have deducted the retained earnings. We have got the retained earnings closing. I have deducted the post acquisition profit and we got the retained earnings at opening. So this will be the formula that we will use for the consolidation. That whenever you have not been given the retained earnings at acquisition, what you need to do is to deduct the post-acquisition profit from the retained earnings at end. Right? We have what we have done here. 180 minus 36 will become 146. I hope it's clear now. So next question is for you guys. You need to calculate the net assets at acquisition. Yes, is it done? Okay, first you need to see that parent company is Carl and subsidiary company is Suzanne. And we need to know the net assets of Suzanne at the date of acquisition. So the share capital, first you need to take the share capital, which is 40,000. Then share premium, we don't have any share premium balance. We don't have any revaluation surplus. Then we are going to take the retainer. So it has acquired the Suzanne company on 1st May. So from the May till the year end is May, June, July, August, September, October, November. It's been actually 7 months. So the 7 months profit will be the post acquisition profit. So retained earnings at end is now 69,000. We need to deduct the post acquisition profit, which is the 7 months profit. So from the 9,000, we need to take the 7 months profit, which is 5250. And then we calculate the retained earnings at acquisition. That will be 63750. By adding these two figures, we got the value of 103. Very good. Do you guys have any issue in this question? Please write in the chat box. No, we never take percentage when you are calculating the retained earnings at acquisition. 69,000 is the retained earning for the last number of years. It's not the profit of the current year. So you need to apply the 7 months profit only for the current year's profit, which was given to you in the question. That is 9,000 in the notes. So here we have got the formula for the calculation of the goodwill, which is important for both section A, B, and C. First, you need to calculate the cost of the investment, means the amount of the investment that the parent company has made to acquire the shares in the subsidiary company, which could be in the form of cash, which could be in the form of shares, which could be in the form of loan notes, could be in the form of deferred consideration and contingent consideration. So there are actually 5 modalities through which the parent company make payments to acquire the share of the subsidiary company. It will be discussed in the next slides. Then NCI acquisition. The amount of the investment of NCI, this will become the total investment that we have made in the subsidiary company, and from which we need to deduct the fair value of net asset that was done. We have already solved 2 questions for calculation of the fair value of net asset at acquisition, and by deducting this figure, we got the value of goodwill at acquisition. And then we deduct the impairment loss, we got the value of goodwill at reporting. There is a difference between the goodwill at acquisition and goodwill at reporting. Sometimes examiner might ask you to calculate the goodwill at acquisition, and it is our normal practice to deduct the impairment loss and report the goodwill. So you do not need to deduct the impairment loss if the examiner was asking for the calculation of goodwill at acquisition. The answer for this question might be in the negative value. So what you need to do, the negative value will be considered as a gain from the bargain purchase and will be recognized in profit and loss account. So in a very simple words, negative goodwill will be considered as an income of the business, which will be recognized in the profit and loss account. Solve this question. Okay, is it done? Cost of the investment is 1 million. NCI acquisition is 2 lakh. The total value of the investment will be 12 lakh. So examiner has already given you at acquisition, share capital, share premium, revaluation reserve, and net earning. So all you need to do is to deduct 9 lakh from this figure. And we will get the value of 3 lakh. I hope it's clear to all of you guys. So what will be the answer for this question? So what will be the right answer for this question? It will be credited to profit and loss. First, it will be credited to the profit and loss, and then it will go in the retained earnings second. The right answer is D. Double entry for the positive goodwill will be goodwill account debit, net assets debit, and cash flow. For the negative goodwill, the accounting entry will be net assets debit, cash credit, because the cash is having a lower value, therefore we need to credit the income sheet. I hope it's done. Now, NCI acquisition can be calculated at the fair value approach or the proportionate approach. Fair value can be given to you in the question, or you can calculate it by multiplying share price of subsidiary into NCI shares. Like if the NCI has got 5,000 shares out of total shares, and the share price of each share of the subsidiary is 2, so the total amount of 10,000 will be an NCI acquisition. So sometimes examiner will give you the NCI acquisition figure, or sometimes it might ask you to calculate the amount. With respect to the proportionate share, if the question is mentioning you that NCI will be based on the proportionate share, then net assets at acquisition that we have learned to calculate multiply by NCI percentage will be used for NCI acquisition. So these are the two ways through which we calculate the NCI. Last slide for a minute. Okay, is it done? If someone wanted to copy it, I want to take the picture of it. I think. Okay, here we have got the question. Proportionate versus fair value. The first requirement is to calculate the goodwill using first time it's for the proportionate and then using the fair value. And the second requirement is to calculate the NCI using the share price. Giving you 1 minute to solve it. I have shared the link of the WhatsApp to all of you guys. If you haven't joined the group, please do WhatsApp me so that I can share with you my link, because for the future we'll be communicating on the group. It's very important for you guys. I've sent the link to all of you almost who have sent me the message. It's very important for you guys to be in the group so that you can enjoy the studies. Okay, let's solve the question. The cost of investment. I'm going to attempt this part of the question is 50,000. No, it's for 78,000. NCA acquisition will be based on proportionate. So we have not yet calculated this figure. Net assets at acquisition is 85,000. So you need to take 20% of this 85,000 for proportionate method. 85,000 to 0.2, it will be 17,000, and then you can calculate the goodwill figure. 78 plus 17 minus 85, you will get the value of 10,000 for goodwill. No, you don't need to include the share capital because it says that the net assets of the correct were, so it includes share capital, share premium, revaluation reserve, and retained. So everything is included in this figure because they have already calculated the fair value of net assets. So this 10,000 is clear to all of you guys. If you have any question, please write in the chat box. As I said earlier, that it's a proportionate method. Proportionate method means that you need to take the percentage of fair value of net assets. So parent company has acquired 80% shares and NCI stake is 20%. So 20% of the net assets will be considered as NCI acquisition. So by taking 20% of NCI, I think it's done. Now, when we are moving towards the fair value approach, we have been given a value of 19,000. So what simply you need to do is to remove the amount of the NCI from here and add fair value, which is 19,000. And when we deduct this amount, the goodwill will be 12,000. So for the first question, the answer is 10,000. For the second one, it's 12,000. What about this one? So how the fair value of non-controlling interest could be calculated if the market price is 1.5? That's important. Yeah, they are more or less same. 1 and 2 is more or less same. But all you need to do is to use the fair value of NCI acquisition. Okay. So subsidiary company has got 50,000 shares, out of which 80% will be acquired by the parent, which is 40,000, and 20% will be acquired by the NCI, which is 10,000. And each share of the subsidiary is having a current market value of 1.9. So the NCI acquisition will be 19,000. This is how we calculate the NCI acquisition in the question in which we will not be given the value. So I hope it's clear now for all of you. So now let's take a short break of 10 minutes. Please give your valuable feedback about this session. How you guys are feeling in this session. Is it beneficial for your concepts? Should ACCA conduct these type of sessions in the future? And are you enjoying? Are you getting the benefits of this session? Please give your feedback. So we are taking a break of 10 minutes and we will start after the break. Okay, guys, welcome back after the break. Talking about the concept of impairment loss. Remember this point that impairment loss will be deducted from both the parent and NCI if there is a fair value approach. Like the accounting entry will be retained earnings debit, NCI debit, and goodwill credit with their respective percentage. This amount, retained earnings and NCI with their respective. For suppose if it is 80-20, so it will be distributed between 80-20. So actually, the share of the impairment loss will be distributed between group and NCI. But when we talk about the proportionate goodwill approach, always assume that the value of the goodwill of NCI is 0. So the whole of the impairment loss should be beared by the parent company. So retained earnings debit and goodwill credit. So there is a difference between the treatment of the impairment loss in the fair value and a particular percentage of goodwill impairment is given. So it will be distributed between group and NCI as normal. Now, cost of the investment. Cost of the investment can be made in the form of cash, loan, deferred consideration, shares, contingent consideration. So these are the methods through which we can make the payments to acquire the shares in the subsidiary company. Examiner might ask you the question that includes some of the different modalities for the consideration, or examiner might ask you a question in which some of the part of the consideration is recorded and the other part is not yet recorded by the parent company. So therefore, you need to know accounting entries for these considerations. So if the consideration was paid in cash, the entry will be cost of investment debit, cash credit. If it is in the form of loan, entry will be cost of investment debit, loan credit. But for this loan, you need to adjust the finance cost as well in the future. If it is related to the deferred consideration, first you need to calculate the present value of that deferred consideration. Deferred consideration means the part of the payment will be made in the future. Cost of investment debit, liability credit, deferred consideration credit. And for this, you need to make the adjustment of unwinding of discount in the future. If it is in the form of shares, accounting entry will be the cost of investment debit, share capital, share premium credit. If it is in the form of contingent consideration, the accounting entry will be cost of investment debit and liability credit. It will be measured at the fair value. Subsequent changes in the fair value will be recognized in the retained earnings. If the value of the contingent consideration changes over the time. If there is a professional fees or acquisition related fees during the acquisition process, it will be recognized as an expense in P&L. Remember these points. These are very important and relevant. So here is a question for you guys. You guys are required to calculate the cost of the investment in this question. And the second thing is to make the accounting entries. Is it done, guys? Okay. Parent company acquired 60% of $100,001 order share in Shakespeare on 1st April 2006. The purchase consideration is made up of a share exchange of 2 in Pearson for every 3. So the proportionate is 2/3. Remember this point, that we are going to issue 2 new shares in place of the 3 shares of the subsidiary company. So the fraction will be 2/3. So first of all, you need to take the number of shares that we have acquired. So we have acquired actually 60,000 shares, on which we are going to make 2/3 new shares. So it will be 40,000. So the accounting entry will be cost of investment debit, share capital, and share premium credit. So remember this point, that share capital will always be recognized with the par value, which is $1. 40,000 multiplied by 1 will be 40,000. The market value of the parent company share is 2.2. So 2.2 multiplied by 40,000 will be 2.2. It will be 88,000. So the remaining will be the share premium amount, which will be 48,000. Remember this point, that these two amounts will be added in the share capital of the parent company. Second thing is that you have issued $100 loan notes for every 500 shares acquired. So we have acquired 60,000 shares. For every 500 shares, we are going to issue $100 loan notes. So it will be 12,000 for the loan. The accounting entry will be cost of investment debit and loan credit by 12,000. So you need to see the date of acquisition. It is on 1st April, as the date of, as the reporting date is not mentioned here. Otherwise, you need to take the interest finance cost of this loan note for 10 at 10%, because it's mentioned here. The third thing is there will be a deferred consideration. So whenever we have got the deferred consideration, accounting entry will be cost of investment debit, deferred consideration credit, but at its present value. So we have acquired 60,000 shares. Every calculation will be based on the number of shares that we have acquired. And for each share, the company is going to make the payments of 1.21. So 1.21 multiplied by 60,000. It will become 72,600. So it is actually the future value, and we need to take the present value of this 72,600 for 2 years. So 72,600, we are going to take the present value of this. It was actually 60,000. The present value of 72,600 using a discount factor of 10% will be 60,000. Is it clear? Do you guys have any problem in it? So the question is, what is the total consideration? Total consideration will be 60,000 plus 88,000 plus 12,000. So the total answer is 1,80,000. The notes and the handouts is available in the handout section of this webinar. You can simply download the handouts from the handout section. How it is 60,000? Actually, we have used the formula for the present value, which is future value 72,600 multiplied by 1.10, 10% is the discount rate, raised to the power minus 2. This is how we have calculated the figure of 60,000. Is it done? But remember this point, that whenever you record anything on the present value, you need to make the adjustment of unwinding in the future. So from the acquisition date till the reporting date, assuming it's being almost 1 year, then you need to make the adjustment for the unwinding of discount by making accounting entry of retained earnings debit and deferred consideration credit. So what will be the figure for the unwinding of discount? It will be the percentage of this 60,000. 60,000 into 10% will be 6,000. So the rate at which you need to get, you calculated the present value will also be used for making the adjustment of the unwinding of discount. With respect to income statement, this unwinding will go in the finance cost in the income statement. How to get 72,000? We have acquired 60,000 shares, and for each share we are going to make the payment of 1.21 after 2 years. So after 2 years we are going to make the payment of 70,600, and this payment was is recorded at present value. I hope it's clear now. Moving towards the next point. So you guys are required to calculate the consideration for this question and make the accounting entries. Giving you 1 minute to solve it. Very good. Students have calculated the figure. 8840. 5,000 they have paid. 5,000 for July 2006. The cash consideration is 5,000. 2 shares for every 5 acquired. For shares consideration, we need to make the payment of 5,000 into 60%. That will be 3,000 into 2 by 5. So, and each share of the parent is having a value of 1.8. 1200 will be value of 2160. And they also agreed to make a payment of 2,000 in 3 years time. So we need to calculate the present value. $1,679. Final answer will be 5,000 plus 2160 plus 1,679. 5,000 plus 8839. That's the right answer for this. Wonderful. Is it clear now? When we talk about the fair value of the consideration payable, you need to add all the considerations. The cash paid is recorded already, so we are not talking about the recording or making double entry. But when it says that you need to make the total consideration, so what will be the total consideration? So you need to add all the figures. Share capital and share premium, accounting entry will be cost of investment debit, share capital and share premium credit. So the total amount is 2160, out of which 1200 will go in the share capital at the par value, which is $1, and the remaining amount of 2160 will be 960 the share premium account. For the deferred consideration, the accounting entry will be cost of investment debit or deferred consideration credit 1679. And for each year end, will make an unwinding of discount, which will be 6% of 1679. For the finance cost, the double entry between income statement debit and deferred consideration credit. 8839 is calculated here. Now, in the consolidation, when we are calculating the fair value of net assets, we need to add the share capital of the subsidiary plus share premium of subsidiary plus revaluation plus retained earnings plus minus fair valuation adjustment. So as the IFRS 3 says that if the legal expense related to the acquisition will also go in the income statement. All acquisition costs will be recognized as an expense in the income statement. Okay, IFRS 3 says that at the date of acquisition, all the assets and all liabilities of the subsidiary should be measured at the fair value. So sometimes there might be some upward fair valuation adjustment or downward revaluation adjustment. So there might be a fair valuation adjustment in the value of property, plant, and equipment. So at the date of acquisition, the market value or the fair value might be more than the carrying amount, or it could be a less than carrying amount. So there could be an upward or a downward revaluation. Similarly, we can have an adjustment or fair valuation adjustment in the inventory as well. There might be upward or downward adjustment in the inventory or intangible asset. All types of intangible asset will be recognized for the purpose of consolidation. Remember this point. Because IS 38 says that you cannot recognize an internally generated intangible assets. But for the purpose of consolidation, all intangible assets will be recognized. Similarly, the contingent liabilities, according to IS 37, we usually disclose the contingent liabilities in notes of the accounts. But for the purpose of consolidation, we'll make the proper liability provision for all these contingent liabilities. So there might be situations where a company might forget to record the deferred tax liability, so it will also be adjusted in the fair value of net assets. So remember that liability should be deducted in the calculation, and if there is an upward revaluation, it will be added, and if there is a downward revaluation, it will be deducted. But there are two items that creates a post-acquisition impact. First is the tangible and intangible. So if you do the revaluation of property, plant, and equipment, then you also need to adjust the depreciation. So if the value of the asset is increasing, then you need to increase the depreciation as well. That's normal science. And if the value of the asset goes down, there will be adjustment in the depreciation as well. Same in the case of intangible asset, because intangible asset with an indefinite useful life, with a definite useful life will be amortized. So whatever with the changes in the intangible asset, it should be adjusted with amortization in the future. Yes, internally generated customer list. All internally generated assets will be assumed to be having independent value for the purpose of consolidation. Yes, inventory rate adjustment will be adjusted in fair value adjustment, definitely in retained earnings. So here is a question for you guys, in which you need to calculate the net assets for the preparation of for the purpose of consolidation. You have now 1 minute to solve it. Okay, so done. P on 1st October, parent secured 80% share of the Shujay, 20,000 or the share of first gen on first $1 shares. At the date of acquisition, the balance on the Shujay's retained earnings were 24,000. So at the date of acquisition, the retained earnings of the company is 24,000. And Shujay enough for a profit of 12,000 during the year. So the retained earnings at end will be 24,000 plus 12,000. So it will be 36,000 at reporting. At the date of acquisition, the fair value of the Shujay's property, plant and equipment is equal to their carrying amount, with the exception of the plant which had a fair value of 6,000 above its carrying amount. So there will be a fair valuation adjustment positive of 6,000. Now for this, you need to make the excess depreciation. First, you need to see at what time that we have acquired till the reporting date. It's being 1 year. So 60,000 divided by 4 will be the value of excess depreciation. As if the time period is less than 12 months, then it will be proportionated based on the time period. Similarly, it says that the customer relationship is also a fair valuation adjustment. Is having a fair value of 4,500. 4,500. So we need to make the adjustment of excess amortization. Excess amortization. So the amount will be 4,500 divided by 6. So when we divide 4,500 by 6, we got the value of 750. So the net assets at the acquisition will be 34,500. And reporting, the value will be 4,500 44,250. So the difference of these two will be the post acquisition profit. Very good. If the year end will be after 5 months, October, November, December, January, February, January, 5 months, then you need to make the adjustments for this excess depreciation for the 5 months and for this portion is 5 years. So that will be the total impact. Share capital will be 20,000. Sorry, we ignore the value of the share capital, which is 20,000. So the answer will be 54,500. And this amount will be 64,000. 64,250. Our excess depreciation is 1,500. There is a revaluation of 24,000 divided by life of 4 years. So there will be a revaluation of 6,000. So when you divide 6,000 by 4, you get the value of 1,500. 100%. Whenever you are making the retained earnings or net assets, we always take 100% values. Remember this one. Now the question for you guys. 1 minute only. Now, we've acquired the shares 75% at a carrying amount. Now, the question says that the fair value of net assets of the at the date of acquisition equal to with the exception of a liability. Now, remember this point. The liability, which there's a carrying amount of 20,000 below its fair value. So the liability is having a carrying amount below the fair value. So you need to upgrade the value of the liability by 20,000. So whenever the liability goes up, it will affect the net assets in a downward way. The fair value of net asset will go down. Whenever there is a decrease in net asset, there will be an increase in goodwill. So the answer will be C. Wonderful. No, I didn't multiply 5 upon 12 for the depreciation. It was actually an example that was asked by one of the students that if there was a 5 months after the date of acquisition, then what will be the adjustment? That's why I write 5 upon 12, but we don't use this 5 upon 12 in the current question. So I hope it's done. The formula for goodwill is cost of investment plus NCI less fair value of net assets. So if there is a decrease in the fair value of net asset, then it will increase the goodwill because it is deducted. So this will increase the goodwill, cost of investment and NCI, and this will actually reduce the goodwill. But whenever there is a decrease in the fair value of the goodwill, there will be an increase in the goodwill. Liability, net assets. Remember this point. Net assets means asset minus liability. if the liability increases, it will decrease the net assets on overall basis. Is it clear? Now, the next thing that you need to know is an NCI at acquisition. When we are going to calculate the NCI at the reporting date for the balance sheet, first you need to take the NCI at acquisition, which we use for the calculation of goodwill, which might be calculated at the fair value or proportionate as discussed earlier. Then share of the post acquisition profit into NCI percentage. So now the post acquisition profit will be distributed between the group and NCI. The part of the post acquisition profit will go in the retained earnings and the remaining in the NCI. Similarly, if there is a fair value method, goodwill into NCI percentage will be the loss beared by the NCI company. So this is how we calculated the NCI at the reporting date. Remember this point that we have already adjusted analyzed profit and excess depreciation while calculating the net assets in the first 2 to 3 slides. Similarly, if there is a revaluation of the parent company, then it will be reported on the balance sheet, and the revaluation of the subsidiary will be taken when the revaluation was done after the date of acquisition. Usually the question will give you the revaluation at the date of acquisition. If the revaluation was done after the date of acquisition, its gain into holding percentage, parent percentage will be recognized. Liability below is fair value. See this point, the carrying amount is 100 and fair value is 120. That means the carrying amount is less than the fair value. So you need to increase the liability by 20. So whenever there is an increase in the liability, net asset will go down. And when the net asset will go down, there will be an increase in the goodwill. H means holding percentage or parent percentage. Holding or parent company. So now in this question, you guys are required to calculate the non-controlling interest. Yes, is it done? Yeah. If there is a if there is a upward or downward revaluation in the post-acquisition period, then this revaluation gain or loss will also be distributed into the NCI. So first of all, you need to take the NCI acquisition. It's mentioned here that is having a value of 1.1 million. Means 1100 then from the date of acquisition till the reporting date, you need to take the, so there is a profit of 3.2 million. Subsidies post acquisition profit is 3200 into 30% for the NCI. So 3200 into 30% will be 960. Then analyzed profit only goes to the parent, and Merrick is a subsidiary company. So you need to see who sold goods to the subsidiary company or parent company. So Merrick sold goods to the Roni. Means subsidiary sold to parent, having a value of 5,50,000 as a profit. So 5,50,000 into 30% will be adjusted as NCI. So analyzed profit will be 550 multiplied by 0.30, it will be 165 for the NCI. And there is an upward revaluation of 1.5 million. So there will be an excess depreciation 1500 divided by 30 years. So there will be an adjustment of excess depreciation. It will be 50 into 30%. 15. So 1100 plus 960 minus 165 minus 15. The answer will be D. 1,880,000. If the sale was made by the parent to the subsidiary, then you need to ignore the adjustment of analyzed profit from NCI. How we get 165? Actually, the profit which has been earned by the parent to the subsidiary is 550, and out of which our share of the adjustment is 30%. Is it clear? Now moving on towards the retained earnings. Parent company's retained earnings will be taken in full. Post acquisition profit into group percentage. Share of associate profit into associate percentage, less impairment loss. Analyzed profit if parent sold goods to a subsidiary. But if the subsidiary sold goods to the parent, it will be adjusted already here. Analyzed profit for the depreciation, fixed asset net of depreciation. Impairment losses into group percentage. Negative goodwill as an income. Unwinding of discount expense. Changes in the contingent consideration. Adjustment. Any gain or loss on parent's investment. And acquisition cost. So this is the format. There might be number of students who has who is having a complaint of they will not be able to get the right answer of the retained earnings. So I am giving you this format. If you try to memorize this format, so if you memorize this format, your retained earnings will be 100% correct. So this is the basic format. This format could be applied on all the questions, and you will get the right answers. So the question is why we have not taken the fair value for the NCI. I didn't get your question. Yeah, we are using the net asset approach. We are using the net asset approach. That's why we didn't adjust the excess depreciation now. So the net asset was adjusted in the first few slides. So you can see the net assets. UP means unless profit of the stock. So I'm giving you this question. This is one of the question that was asked by the examiner in the examination, and people will not be able to answer this question. So I want you guys to attempt this question. Just giving you 1 minute. Yes, you can see this lecture on the Vimeo. This will be uploaded by on the Vimeo by tomorrow morning. So please do attempt this question, as we are already running short of time. Patter Company acquired 80% of the issued share capital of Sonu Company on 1st May 2001. Okay. When the balance on the Sonu Company retained earnings were 5,40,000, 5,20,000. So this was the retained earnings at acquisition. On 15th November, Sonu made a 240,000 sales with goods to Patter, on which Sonu made a markup of 20%. Tata Company subsequently sold 1/4 of these goods to external parties at 31st December, the retained earnings of the Tata. So while calculating retained earnings, first we need to take the retained earnings of the parent company, which is the Tata, which is 4 million. For the subsidiary, which is Sonu, we need to take the post-acquisition profit. At the date of acquisition, it was 520, and at the reporting date, it's now 3.4 million. So 3,400 minus 520. So there will be a post-acquisition profit of 2,880, in which our share is 80%. 2,880 into 80%, it will be 2,304. And the last thing is the unrealized profit. First, you need to see that whether the parent is selling the goods or the subsidiary. So it was actually the subsidiary who's selling the goods to the parent. So there is a sale value of 2,40,000, in which 1/4 was sold, means 3/4 is still held in the inventory. So 1/4 means 25% was sold, remaining 75% is still held. So it will be 180. You can take 3/4 or 75%. And there is a markup of 20%. So it should be divided by 120. It's the sales value multiplied by 20. How to get the value of the profit and this figure. So the value of the analyzed profit is 30. So 30 into 80%, 24. So the total amount of the answer will be 23, 4, 6280. Is it done? Yeah. When the subsidiary sold goods to the parent, the subsidiary was actually earning the profit. So its profit will be distributed between the group and NCI. It says that at the date of acquisition, the profit is 520. And now it is 3400. So there will be a post-acquisition profit of 2880. I hope you have understand this point, and the time is over now. I think I'm 6 minutes over the time. So I hope you guys have enjoyed the session today, and it has given you some benefits in terms of improving your key concepts about the consolidation. So tomorrow we'll be starting with the same topic, consolidation, in which we'll be covering the consolidated balance sheet and the income statement. So till tomorrow, I am recommending you guys to take the the slides from the handout section and try to revise these slides. And you'll be having the video lectures, video of this lecture that has occurred today on the Vimeo. I will share the link by tomorrow. And there are 2 handouts in this handout section, 2 practice handouts. I can show you the handouts. The first one is related to the MCQs, in which you guys are required to attempt all the MCQs related to the consolidated balance sheet. This is the handout, MCQs handout. And the second handout is related to the long question, this one, in which you guys are required to attempt the question of consolidated balance sheet. You can calculate the goodwill, NCI, and retained earnings that we have covered till today. So thank you so much for time today, and we will be meeting by tomorrow on the same time at 8:30 sharp. And the guys who have not yet edit or include in the WhatsApp group, I'm requesting you guys to please join the WhatsApp group so that we can communicate. And I will share the special plan for the guys who got flunked tonight, so that they can prepare themselves to pass the paper in first step. Thank you so much. Take care of yourself. Goodbye and Allah Hafiz.